Welcome! Today, we're diving into the world of estimated taxes. If you're self-employed, a freelancer, or have income that isn't subject to regular withholding, understanding estimated taxes is crucial. Unlike traditional employees whose taxes are withheld from each paycheck, you're responsible for calculating and paying your own taxes throughout the year. This system helps the government collect revenue steadily and prevents taxpayers from facing a huge bill at tax time. Let's break down how estimated taxes work, who needs to pay them, and what happens if you don't. By the end, you'll have a clear grasp of this essential financial responsibility. Estimated taxes aren't just for business owners. If you receive income from sources like self-employment, rental properties, investments, or even side gigs, and taxes aren't automatically withheld, you may need to pay estimated taxes. The IRS generally requires estimated payments if you expect to owe at least $1,000 in tax after subtracting your withholding and credits. This applies to individuals, sole proprietors, partners, and S-corporation shareholders. Understanding whether you fall into this category is the first step in managing your tax obligations effectively. The U.S. tax system is pay-as-you-go. This means taxes are supposed to be paid as income is earned, not just at the end of the year. Estimated taxes help ensure that people who don't have taxes withheld from their income still contribute regularly. This system keeps government cash flow steady and helps taxpayers avoid a large lump sum payment and potential penalties at tax time. It's a way to spread your tax liability throughout the year, making it more manageable and predictable. Estimated tax payments are typically made quarterly. The IRS sets 4 payment deadlines throughout the year: April, June, September, and January of the following year. Each payment covers income earned in the previous quarter. It's important to mark these dates on your calendar and plan ahead, as missing a deadline can result in penalties. By breaking up your tax payments, you can better manage your cash flow and avoid surprises when tax season arrives. To calculate your estimated taxes, you'll need to estimate your total income, deductions, and credits for the year. Start by projecting your earnings from all sources, then subtract any deductions you expect to claim. Next, apply the appropriate tax rates to determine your total tax liability. Finally, subtract any tax credits and withholdings you may have. The remaining amount is what you'll divide into 4 quarterly payments. It's a good idea to use IRS Form 1040 ES, which provides worksheets and instructions to help you through the process. IRS Form 1040 ES is the tool you'll use to calculate and pay your estimated taxes. It includes worksheets to help you estimate your income, deductions, and credits, as well as payment vouchers for mailing your payments. The form is updated annually, so be sure to use the latest version. You can also use the IRS's online payment system for added convenience. Keeping this form handy and understanding how to use it is key to staying on top of your estimated tax obligations. Not all income is subject to withholding. Common sources requiring estimated tax payments include self-employment income, interest, dividends, rental income, alimony, and capital gains. Even if you have a regular job, side income from freelancing or investments may push you into the estimated tax category. It's important to track all your income sources throughout the year to ensure you're meeting your tax obligations and avoiding surprises at tax time. Some taxpayers are exempt from making estimated tax payments. If you had no tax liability in the previous year, were a U.S. citizen or resident for the entire year, and your prior tax year covered a full 12 months, you may not need to pay estimated taxes. Additionally, if your income is subject to sufficient withholding, you're generally off the hook. Always review your situation each year, as changes in income or deductions can affect your requirements. Making estimated tax payments is straightforward. You can mail a check with the payment voucher from Form 1040 ES, or use the IRS's electronic payment options such as Direct Pay or the Electronic Federal Tax Payment System, EFTPS. Many people find online payments more convenient and secure. Be sure to keep records of all your payments, as you'll need this information when you file your annual tax return. Missing an estimated tax payment can result in penalties and interest charges from the IRS. The penalty is calculated based on the amount you underpaid and how late the payment is. However, if you have a reasonable cause, such as a natural disaster or serious illness, you may be able to request a waiver. It's always best to pay on time, but if you miss a deadline, make the payment as soon as possible to minimize penalties. The IRS offers safe harbor rules to help you avoid penalties. If you pay at least 90% of your current year's tax liability, or 100% of last year's tax, 110% for high earners, you're generally protected from underpayment penalties. These rules provide a cushion for taxpayers whose income fluctuates or is hard to predict. It's wise to use these benchmarks when planning your estimated payments. Life happens, and your income may change during the year. If you experience a significant increase or decrease in earnings, you should recalculate your estimated taxes and adjust future payments accordingly. This flexibility helps you avoid overpaying or underpaying, keeping your finances on track. The IRS allows you to update your estimates each quarter, so don't hesitate to make changes as needed. Self-employed individuals are among the most common payers of estimated taxes. Since there's no employer to withhold taxes, you're responsible for covering both income tax and self-employment tax, which includes Social Security and Medicare. It's important to factor in these additional taxes when calculating your quarterly payments. Keeping detailed records of your income and expenses will make this process much smoother. Small business owners, including sole proprietors and partners, must also pay estimated taxes. In addition to income tax, you may owe self-employment tax and, in some cases, excise taxes. It's essential to set aside a portion of your business income each month to cover these obligations. Many business owners open a separate savings account just for tax payments, making it easier to manage and avoid spending money earmarked for taxes. Investors who earn significant income from dividends, interest, or capital gains may need to pay estimated taxes. Since investment income isn't typically subject to withholding, it's your responsibility to estimate and pay taxes on these earnings. Keeping track of your investment income and making timely payments can help you avoid penalties and interest charges. If you own rental property, the income you receive is generally not subject to withholding. This means you'll need to estimate your annual rental income, subtract allowable expenses, and pay estimated taxes on the net amount. Proper record keeping is essential, as you'll need to document both your income and expenses to accurately calculate your tax liability. Gig economy workers, such as rideshare drivers or delivery app contractors, often receive income without any tax withholding. If you earn money from gig work, you're responsible for estimating and paying your own taxes. This includes both income tax and self-employment tax. Setting aside a percentage of each payment you receive can help you stay on top of your tax obligations. Estimating your income can be challenging, especially if your earnings fluctuate. Start by reviewing your income from previous years and consider any changes that might affect your earnings this year. If you're unsure, it's better to slightly overestimate your income to avoid underpayment penalties. As the year progresses, update your estimates based on actual income received. When calculating estimated taxes, don't forget to factor in deductions and credits. Common deductions include business expenses, retirement contributions, and health insurance premiums for the self-employed. Tax credits, such as the child tax credit or education credits, can also reduce your estimated tax liability. Keeping track of these items throughout the year will help you make more accurate payments. To avoid underpayment penalties, make sure your estimated payments are accurate and timely. Use the safe harbor rules as a guideline, and update your estimates if your income changes. If you're unsure, consider paying a little extra each quarter. The IRS provides penalty calculators and worksheets to help you determine if you're on track. Good record keeping is essential for managing estimated taxes. Keep copies of all payment vouchers, receipts, and confirmation numbers for electronic payments. Maintain detailed records of your income, deductions, and credits. These documents will be invaluable when it's time to file your annual tax return and can help you resolve any disputes with the IRS. In addition to federal estimated taxes, many states require their own estimated tax payments. The rules and deadlines may differ from the IRS, so check with your state's tax agency for specific requirements. Failing to pay state estimated taxes can result in additional penalties and interest, so it's important to stay informed and compliant. Retirees who receive income from pensions, Social Security, or investments may also need to pay estimated taxes. If taxes aren't withheld from these payments, or if you have significant investment income, estimated payments may be necessary. Review your sources of retirement income and consult with a tax professional if you're unsure about your obligations. Farmers and fishermen have special rules for estimated taxes. If at least 2/3 of your income comes from farming or fishing, you may be able to make just one estimated payment by January 15 of the following year. This exception recognizes the seasonal nature of these professions. Be sure to review IRS guidelines to see if you qualify for this special rule. S-corporation shareholders may need to pay estimated taxes on their share of the corporation's income, even if they don't receive cash distributions. This is because S-corporations are pass-through entities, meaning income is taxed at the shareholder level. If you're an S-corporation shareholder, be sure to include your share of the company's income when calculating your estimated taxes. Partners in a partnership are responsible for paying estimated taxes on their share of the partnership's income. Like S corporations, partnerships are pass-through entities, so income is taxed at the individual partner level. Be sure to include your share of partnership income, deductions, and credits when calculating your estimated payments. Trusts and estates may also be required to pay estimated taxes if they expect to owe $1,000 or more in tax for the year. The rules are similar to those for individuals, but special forms and calculations may apply. If you're managing a trust or estate, consult the IRS instructions or a tax professional to ensure compliance. If you overpay your estimated taxes, you have options. You can request a refund when you file your annual tax return, or you can apply the overpayment to your estimated taxes for the following year. Many taxpayers choose to roll over the excess to avoid having to make a large payment in the first quarter of the next year. If you underpay your estimated taxes, you may owe penalties and interest. The best approach is to pay the shortfall as soon as possible to minimize additional charges. You can also adjust your remaining payments for the year to catch up. The IRS provides penalty calculators to help you determine the amount owed. If you have a regular job and receive a paycheck, you can increase your withholding to cover additional tax liability from other income sources. This can help you avoid making separate estimated tax payments. Submit a new Form W-4 to your employer to adjust your withholding as needed. Married couples can make joint estimated tax payments if they file jointly. Combine your income, deductions, and credits to calculate your total estimated tax liability. If you file separately, each spouse is responsible for their own estimated payments. Coordination is key to avoid underpayment or overpayment. Non-resident aliens may also be required to pay estimated taxes if they have U.S. source income not subject to withholding. The rules can be complex, and special forms may be required. It's important to review IRS guidelines or consult a tax professional to ensure compliance with all requirements. If you're subject to the alternative minimum tax, AMT, you must include this in your estimated tax calculations. The AMT is a separate tax calculation that ensures high-income earners pay a minimum amount of tax. Use IRS worksheets or consult a tax advisor to determine if the AMT applies to you and how it affects your estimated payments. Minors who earn income from investments, self-employment, or other sources may also need to pay estimated taxes if their income exceeds certain thresholds. Parents should help their children track income and understand their tax responsibilities. The rules can be complex, so consult IRS guidelines or a tax professional if needed. Many tax software programs can help you calculate and pay estimated taxes. These tools guide you through the process, help you estimate your income and deductions, and generate payment vouchers. Using software can reduce errors and make the process more efficient, especially if your financial situation is complex. If you're unable to make your estimated tax payments on time, the IRS offers payment plans. These plans allow you to pay your tax liability over time, but interest and penalties may still apply. It's best to contact the IRS as soon as you realize you can't pay in full to discuss your options and minimize additional charges. Filing a tax extension gives you more time to file your return, but it doesn't extend the deadline for paying estimated taxes. You must still pay any taxes owed by the original due date to avoid penalties and interest. If you're unsure of the exact amount, pay your best estimate to minimize charges. If you overpay your estimated taxes, you can request a refund when you file your annual return. Alternatively, you can apply the overpayment to your estimated taxes for the next year. This flexibility helps you manage your cash flow and avoid large payments in the future. If you discover an error in your estimated tax calculations, you can file an amended return to correct it. This may result in additional tax owed or a refund. It's important to address mistakes promptly to avoid penalties and interest. The IRS provides forms and instructions for filing amended returns. If the IRS determines you've underpaid your estimated taxes, you may receive a notice outlining the amount owed, including penalties and interest. Review the notice carefully and respond promptly. If you disagree, you can appeal or request a waiver if you have reasonable cause. Ignoring IRS notices can lead to further action, so always address them quickly. Estimated taxes are an important part of overall tax planning. By projecting your income, deductions, and credits, you can make informed decisions throughout the year. Regularly reviewing your finances and adjusting your estimated payments as needed can help you avoid surprises and keep your tax situation under control. If you're unsure about your estimated tax obligations, consider consulting a tax professional. Accountants and tax advisors can help you calculate your payments, identify deductions and credits, and ensure compliance with IRS rules. Professional guidance can save you time, reduce stress, and help you avoid costly mistakes. The IRS provides a wealth of resources to help you understand and manage estimated taxes. Visit the IRS website for forms, instructions, calculators, and FAQs. These tools can guide you through the process and answer common questions. Staying informed is key to meeting your tax obligations. Common mistakes with estimated taxes include underestimating income, forgetting to include all sources, missing payment deadlines, and failing to adjust payments when circumstances change. Avoid these pitfalls by staying organized, reviewing your finances regularly, and using available tools and resources. To wrap up, estimated taxes are a key part of managing your finances if you have income not subject to withholding. By understanding who needs to pay, how to calculate and make payments, and how to avoid penalties, you can stay compliant and avoid surprises. Remember to review your situation regularly, keep good records, and seek help if needed. With the right approach, estimated taxes can be manageable and stress-free.